Hi there, I'm Ben Jones and you're watching Dukascopy TV. It's the end of another trading week, so joining me to look at some of the key events of the week just gone is Danae Kyriakopoulou from the Centre for Economics and Business Research. So Danae, to begin with, towards the start of the week, we had both manufacturing and construction PMI data for the UK. Manufacturing PMI hit forecasts, going slightly up to 56.9, whereas construction PMI fell below expectations, dropping to 62.6. Both are still quite strong figures though, so what can we take from this?
February's PMI results were just another brushstroke in a generally rosy UK picture since the start of 2014. Now, as you said, the construction PMI was marginally below expectations, but we believe this may have been a catching for breath moment for the construction sector after having recorded a 6-year high in January. And after all, reading after 50 signifies output expansion, and both the manufacturing and the construction measures were comfortably above that level, so there was nothing negative about this week's release. Overall, it is of course encouraging news to see output growing strongly in all main sectors, and this suggests that the recovery in the UK continues to proceed in a balanced way, and it has a strong base in all three main industry sectors of the economy. Looking forward, the PMIs tend to be a generally good and reliable leading indicator of output growth, and so for this quarter, we received this week's release well in line with our forecasts for the performance of the UK economy in the first quarter of 2014. We expect 3.6% year-on-year growth in the first quarter of this year, the fastest seen since the final quarter of 2007. And we also expect a strong 3.3% annual growth over 2014 as a whole.
Now, later on in the week, we had an interest rate decision for the Eurozone and a speech from Mario Draghi. The rate remained unchanged as expected. Now, in Draghi's speech, he seemed very positive and upbeat about the future of the euro area, which boosted the currency. What were some of the key things that he outlined?
This generally upbeat and positive spirit, as you described it, was definitely one of the key features of Wednesday's speech, with Draghi trying once again to use his position and his confidence as a means to calm the markets. Now, this optimism was based on a generally strong set of data from February. GDP recorded positive growth for the third consecutive quarter in the final quarter of 2013, and the composite market PMI also rose to its highest level since 2011, I believe, in February. This eased pressure on the ECB and relaxed this sense of urgency for monetary action. The key message for me was that this lack of sense of urgency is something that is likely to be carried forward to the next meeting. Unlike Draghi's last speech, when he suggested that more data were needed before deciding on definite action, this time he seemed confident that inflation expectations are well anchored and that the recovery, while still slow and weak, is proceeding. And finally, Wednesday's speech was also uniquely interesting as it was the first time the ECB published its official inflation projections up to 2016. These project a benign outlook for a prolonged period for low inflation, to be followed by gradual movement towards the bank's target of 2%, but only to reach 1.7% in the final quarter of 2016. Given this, we expect rates to remain at present or lower levels for an extended period of time.
And finally, we've had US employment data out today. Further improvement in non-farm employment change, jumped up by 175k. However, the unemployment rate has unexpectedly gone up to 6.7%. How do you see this affecting the US economy?
Today's US jobs report was good news for the US economy. It highlighted the recovery supported by strong fundamentals. I wouldn't place much emphasis on the unemployment rate going up. Most important was the upward revision for weak employment data in December and January, which had been seen as out of line with a rosier outlook earlier in 2013, which was what prompted the Fed to start tapering in the first place. Now, in terms of how this will be affecting the U.S. economy, the most important channel would be monetary policy. The Fed has been closely watching the labour market data to guide its policy decisions, and Yellen repeatedly has been saying that while the recent softness in labour market data could be partly explained by adverse weather conditions, it is not entirely clear how much of that is due to that versus structural challenges. Today's strong data may lead to a hawkish call for faster tightening, but CBR expects the Fed to continue to taper its present rate and gradually taking the stimulus from the present $65 billion to zero.
Danae, thank you for talking to us today. That's all we've got time for, I'm afraid. Thanks for watching, and make sure you tune in to Dukascopy TV next week for even more updates and exclusive interviews. Bye for now.